Coming up today, stocks hit record highs again. Tesla hits 1 trillion market cap. Will the Fed increase rates next year? Consumer sentiment climbs. China disappoints the market. Tom Lee's Bitcoin prediction. Australia comes after Meta. And where to next for the stock market? It's been a great week, guys. Let's finish strong. And welcome back to the Daily Market Review, everybody. Thanks very much for tuning in with me here today on what was another monster week for the stock market and, in fact, all global financial markets. I definitely had my best week of the year looking across the sum of all my portfolios. I hope you did too. At least if you're a bull, this should have been another good week for you. And there's a look at how all major stock sectors have performed this week. No points for guessing when the election was. Right here. And we could already see going into it, two distinct groups of stock sectors that has been exacerbated ever since we got the results of the election. Doing the best since then, consumer discretionary stocks, then tech, industrials, financials, energy and communications. And in the bottom performing group, doing a lot different, utilities, REITs, healthcare, materials and staples. So in other words, there's been a huge rotation into growth ever since the election. In fact, what's done even better that I just added to this chart, small caps, Russell 2000 up 9.1%. And even better than small caps, I just added to this chart, Bitcoin up 12% this week. And so just like Americans clearly spoke, so has the market. They're expecting good times ahead, getting back into the cyclical growth, high beta shares. And I'm going to show you a bunch of charts on everything that's moving soon. And stick with me today because I've got an interesting one for you. I'm going to show you some data on Bitcoin later. We'll also talk about Australia coming after Meta and I'll also get you updated on the latest from China and give you an inside look at the TIGR Brokers trading platform for which I just opened an account with. I'll give you my thoughts on that, along with a lot more other interesting stuff I'm seeing out there today. But first, let's start off with the biggest story today, what everyone's talking about. Tesla, ripping up again today, up 8%, now back into the $1 trillion market cap club, $321 a share. You guys remember when I told you just before earnings, I was buying the dip, adding to my long-term position. Unbelievably, it's up almost 50% since then, and not even a month. Like I always say, when Tesla moves, it can move, and it's definitely a stock you don't want to short. Unlike a lot of bears were telling you after the earning. They turned out to be wrong once again, but if you guys were watching Click Capital, you'll remember on that earnings day, I made a bullish case to why it could be the start of a new bull run. Just had to make its way through a big resistance zone around 280, which it's absolutely smashed through this week, up 29% on the week alone. And since the stock has been consolidating for over 3 years now, maybe this big long consolidation and base gets resolved on the upside, as it's held up remarkably well in the face of higher rates, stiff competition from China, an unfriendly administration. However, Elon's all-in political bet looks to be paying off in spades already, and now he's going to have a huge political tailwind. And that's why the market's really jumped on board this week, along with their really good earnings and all the excitement about new products around the corner. Another showstopper this week, Palantir Technologies, booming AI stock ever since they had their good earnings on Tuesday. Stock's up 39% this week alone, and that's helped my new investing account I run for my stock pick service have its best week since inception. In fact, just looking at the chart, ever since I started it back in June, I buy $500 of a new stock every Monday. It's already up 19% just in a simple return. And that's thanks to Palantir being the biggest position, now up over 140% since I first bought it. But it's not just Palantir, the whole AI trade is lighting up, especially on the smaller end. SoundHound AI having another good day today. We'll get their earnings next week, for which we just got earnings for another AI small cap today. And just like I've been saying this week, we are getting massive reactions to earnings beats. They did come in with a really good beat here, 269% actually, and the market is just absolutely loving it. Up 75% today on huge volume for this AI stock. Another one as well, Tempest AI, didn't even have their earnings today, still slapped on another 29%. But the big fella took a bit of a breather. Nvidia, pretty much flat today. Got their earnings in a week and a half, still the biggest stock in the market, sitting at all-time highs. And I'm pretty sure they'll beat on earnings estimates, even though they're really lofty. How the market reacts could be a different thing though. But they're just so dominant. And it's just so hard to imagine a future where AI isn't a huge part of just about everything. It's going to touch all industries, products and services eventually. And I think the future will be a world where it's those that own and benefit from AI, those that use AI, those that watch AI, and those that criticize AI. Other notable movers today, Upstart Holdings, 46% on earnings. Sezzle, 72%. Some of these smaller software stocks are absolutely smashing estimates, and the market is absolutely loving it. Even large caps are catching a big bid. Axon Enterprise, they're the company behind the taser guns and all the personal cams on most American police. Up 28% today on earnings, even though they only beat by 21%. American manufacturing could be coming back. Looking at AXL, American Axle and Manufacturing Holdings, having a good day on earnings. RFK is determined to make America healthy again. That could potentially be a tailwind for the health and fitness industry. Exponential Fitness today, operator of health clubs, up 29%. Even though they missed on earnings expectations by a lot, market loved their forward guidance. Nuclear uranium trade still marching higher. Same deal, SMR missed on their earnings estimates. Market initially gapped down, then shrugged it off like it was nothing, up 13%. Quantum computing been running hard of late, just like nuclear. Leader of the pack, IonQ, up another 12% today. They too just missed on earnings. And eVTOL stocks are coming back as well. That's electric vertical takeoff and landing. eVTOL stocks. Archer Aviation up 11% today. And one that David Einhorn, billionaire hedge fund manager, told us a few weeks ago, Peloton, coming back from the dead, ripping up another 11% today after they had a pretty good earnings last week, managed to break even. And just going out to a weekly chart on Peloton, one of these really beaten down high growth flyers from the COVID bull run, put in this long base, could be curling up here. Kind of reminds me a little bit of Carvana, the look of it, whereas Carvana already moved a year ago. It was so beaten down here, put in this base, and then climbed up out of that base on these really big fat green accumulation candles. And this has put in almost 100x return from the low. You can get these really big moves. Companies that have been written off for dead, they somehow hang around. Then as soon as they start getting back to growth, beating on estimates, the market's like, hang on, this is actually a decent company. They're going to make money. Institutions, the street analysts, everybody's given up on it, and it sets up for an awesome contrarian turnaround play. Carvana bottomed at $3.50 a share. Here we are 2 years later, $244. Is Peloton about to do the same thing? Current market cap $3.3 billion. If they can get consumers, especially wealthy consumers, warming back up to their product, certainly possible they could get back to a market cap 20, 30 billion. Who knows? Maybe more. We'll keep an eye on it. Just like other similar knockdown high growth stock, Zoom Video, also peeling up from this base, just like PayPal has been doing a very similar thing. Like all of them except Carvana, still well off those 2021 highs. But this is good technical signs we've got going on here. Also doing well today, Costco, breaking out to another all-time high. This is one of the best performing stocks of all time. One of the late Charlie Munger's favorite. He famously said in his latter years, the Munger family only holds 3 investments: Berkshire Hathaway, a partnership with Li Lu to invest in Chinese shares, and Costco. He was a big believer in the stock, and once again, shareholders have been rewarded today. Also getting a nice bounce back in some of these knockdown utilities. Renewable energy stock NextEra having a nice bounce here today. And interestingly enough, the retail sector still pressing up against this resistance zone. Hasn't appeared to be knocked down too hard after the threat of Trump tariffs. However, what is feeling the pinch of that threat today? Chinese shares. We got their stimulus package. However, they appeared to pump the brakes a little bit. I think they want to wait and see exactly what tariffs are going to get slapped with and then counteract that with some more fiscal stimulus at that point in time. Either way, the market wasn't impressed. Chinese securities traded down today. TIGR brokers still as volatile as ever. We get to hear from their earnings next week. No doubt there could be some more volatility. However, I just opened a real money trading account with TIGR brokers. I thought, why not? I plan on being a long-term shareholder in the company. I might as well be a customer and become really familiar and comfortable with their product and platform. And I've got to say right off the bat, I'm pretty impressed. Now first, let me just disclose, I don't have any relationship with this company. They haven't paid me for this. I'm not an affiliate. I'm not advising you to open an account with them. I'm just giving you my honest opinion and review as a trader and investor. And it's a lot more in depth than what I thought. It'd be pretty good for active traders. Comes with a lot of inbuilt, included analysis, stuff that you wouldn't normally find in most brokerage platforms. A lot of data, a lot of cool visuals and analytics, just about everything you would want just to get a good look at a company and understanding. All the charting tools. You got access to a lot of different markets. You can trade Chinese mainland shares directly, Hong Kong shares, Singapore, Australian, American. And it kind of reminds me of like a Chinese version of Interactive Brokers Trader Workstation, as they've actually partnered with IB for some of their back-end technology. And that's kind of IB's main advantage, is they offer access to markets all around the world and heaps of different exchanges. Pretty reasonable pricing as well. Stocks, options, ETFs, futures, they've got it all. And so it makes me more confident as a long-term shareholder in this company. I think it's a great way to get exposure to the growth of Southeast Asia and China through a company headquartered in Singapore. Takes away a bit of that China risk, at least directly anyway. And so I've got a feeling they're going to come through with a pretty good earnings. Is my hunch since we got all that talk of China stimulus after their last earnings. Wouldn't be surprised if they've attracted a lot of new accounts, me being one of them, not to mention dormant accounts, getting new deposits, and a huge increase in trading in Chinese and Hong Kong shares, not to mention American shares as well, which they offer. So I'll certainly be interested in diving into all their earnings results next week, and I'll share that with you guys as well. Again, this is not financial advice. Please do your own research. I'm just sharing with you some things that I'm interested in. And stick with me because I'll talk a little bit about China in a minute. So while everything in the market's looking pretty good now, huge repricing, pro-business administration, the market's loving it, got a lot of momentum, corporate earnings. Let's talk a little bit about some key risks that could be upon us in the near term around the corner, maybe Q1 next year, after we finish the bullish seasonality seasonality, finish the year out. S&P could easily add another 3, 4, 5% by the end of the year. Take us to 62, 6,300 on the S&P 500. We'll see whether the stock market can hold up if the bond market starts significantly repricing the Fed's path of cutting interest rates, which may have already started, which the stock market doesn't seem to care about at this point in time. However, the new administration's tariffs and immigration policies could indeed be a little bit inflationary to begin with, but it's not just that, it's also rates getting cheap again, bubbling asset prices, consumer spending still strong, and wouldn't it just be a huge flip-flop if the Fed actually jacked up rates next year or potentially went on hold a lot sooner than what many of us are expecting? This is something I've been talking about for a couple of months now. That J Powell could certainly change his path. Some of it justified, some of it I'm not so sure, but either way, the market is definitely starting to reprice things here. Looking at Fed Fund futures again today, increasing their chances the Fed could stay on hold in December, last meeting of the year, week before Christmas. Currently giving it a 1 in 3 chance. Got a feeling this may climb if we keep seeing solid economic data, markets keep ripping, and plans for tariffs become more clear. But like I said, some of it could be justified because the economy is holding up well, at least looking at the data that's been reported. And so I hear from a lot of people all the time, things have never looked as bad. And I agree that's the case for a lot of consumers, unfortunately, who've been bitten by inflation. However, you got to understand the market just reacts to the numbers it's been fed, and the numbers it's been fed of late are pretty good. Once again today, consumer sentiment climbing to the highest reading in over half a year, showing Americans are the most optimistic about the economy since 2021. And we can see that today in the United States Michigan Consumer Sentiment Survey. Here's a look at a 3-year bar chart. Climbing up here today and just going out to a 10-year bar chart. We're still well off the prior admin's first term, 2017 through 2020, but it is climbing back, and what's really climbing back is consumer expectations. In fact, just broke out to a brand new 3-year high. Again, still well off the levels when the economy and Americans were feeling really good in 2019. Imagine we didn't get COVID. Things were just humming along, and how that just changed the world and so many other things, the chain of events that set off. Of that virus being released from a lab exactly 1 year before the US federal election. Guess it was just another coincidence, right? But anyway, that's how it all went. It appears nature's healing, and along with that, how consumers are feeling and their expectations going forward. And the ball is already rolling on a number of things. We've already heard the European Union getting really worried about tariffs, as the new American government could be about to impose a global tariff for the first time. So Chinese companies can't bypass a China tariff by selling all their goods to other countries who then sell it to the Americans. EU says it wants to buy American natural gas. Putin said he'll sell Russian oil in US dollars. Putin's been talking about he's still willing to do trade in US dollars. Hamas is calling for peace, and Zelensky held a private phone call with Trump and Musk, in which they told him the war's over, prepare for negotiations, and that no additional funds or weapons will be sent to Ukraine. With Elon Musk quoted as saying, the senseless killing will end soon, time is up for the warmonger profiteers. However, we could still see some tension with Iran. That might need to reach a bit of a blow off top before it gets better. New admin could drastically increase sanctions on Iran and throttle its oil sales. And since Iran doesn't look like they're going to back down, they may have to get cut down. However, plenty of the biggest voices in finance are optimistic. Billionaire hedge fund manager Bill Ackman, and another one of his classic long posts today, talking about a new beginning, a new direction for the country. And same with billionaire Mark Andreessen, who runs one of the top venture capital firms in the world. This guy who created Netscape Navigator, the first internet web browser, said America is an economic coiled spring. We should be growing at least 4% annually, and ideally 6 to 8%. Growth has been brutally suppressed since before I was born. There is so much to build, and the payoff for all Americans will be incredible. And so a big thought process across the finance community is American exceptionalism's run too far. The outperformance from the rest of the world's just got crazy. American stock valuations are just unjustified. However, what if some of the smartest guys in the world are right, and American exceptionalism could be about to accelerate on the upside? And if that were the case, even as stretched as the S&P 500 is, maybe actually hard to have that big crash the bears are hoping for if the economy is still humming along and can actually grow above 4%. I certainly wouldn't rule it out, and I agree with Mark that the potential is there. In fact, he also posted today that the roaring 20s is here, as he's excited too about the new path for the United States of America. And the fact is, corporate earnings are just at an all-time high and expected to actually accelerate next year. Looking at S&P 500 EPS here. Again, if that were the case, there's no reason the market should fall by more than 20%. Apart from some short-term shakes and wobbles, it's really hard to have a structural bear market if corporate earnings and economic GDP are accelerating to the upside. And the bulls just got another wonderful signal today from the man who never misses. Jim Cramer, S&P 500, 6,000. Doesn't anyone else see crazy this all is? Not only has he got wrong grammar, he's got an amazing amount of market calls wrong as well. And this is something that gets us bulls excited. And especially us small cap bulls, like Tom Lee. As a new presidency could help small caps soar in the coming years, as they're more leveraged to the American economy. And that's what tariffs objectives are. And America's pretty much the only country in the world that can really do this on a global scale and enact its leverage, influence other countries, but also more importantly, encourage domestic production. So instead of companies importing from the rest of the world, getting American-made products is going to start looking a whole lot better. Not only for patriotic reasons, but more importantly for most people, economic reasons. Not to mention talk of potential lower tax rates for domestic producers. All this could create a strong multi-year structural tailwind for small caps. And now also that we could potentially be on the verge of a red sweep. Republicans controlling the White House, Senate, and lower house. Like I said, it'll be a much different second term for Trump than his first term. He'll be able to enact his political agenda a lot more easier. Deregulation, lower corporate taxes, plus all the experience he's learnt from the first term, a far more competent, talented, and determined team this time. Elon Musk, world's richest man, absolute game changer. And hopefully most Americans can see through the next BS hoax or controversy the mainstream media is no doubt set to manufacture, and instead most people can just focus on economic growth for the benefit of everybody. And like I said, I really like the look of the long-term monthly chart on the Russell 2000 small cap ETF, which appears to be breaking out of this long multi-year base. You compare that with S&P 500, which is light years ahead of small caps, but no doubt a really strong momentum march here that could continue on before we no doubt have a bit of a pullback and correction and let time catch up to price a bit. So the world's just pretty much been pushed onto an entire new path, and it's going to take a little while for all the cards to fall. Still a lot of things yet to be seen. China just announced $1.4 trillion plan to rescue its local governments, which was a pretty big number. I thought the market may have been a bit more impressed than what it was. However, apparently investors were looking for more. But this may not be the last of it, which would actually make a lot of sense. They don't know exactly what tariffs they're going to get slapped with, nor the rest of the world. They need to reconfigure their strategy at that time and potentially counteract it with some more stimulus as well. Try and keep confidence in their capital markets. And like one Chinese analyst that I follow, the Chinese don't have a problem with their consumption, investments, manufacturing. They're all growing. There's real estate. They really need to get underneath their property sector. Just got hit so hard, literally tearing down cities of skyscrapers, overbuilt like crazy, blew up the bond market, not to mention their REITs over there, caused a bit of a crisis in consumer confidence, more so in the capital markets, especially foreign institutional capital that fleeted the country. Started with the narrative last year, China's dead, uninvestable, which still many are holding on to. However, all in all, China down 5.8%, and I know that's normally a big move for most other international developed indices out there, but for China, and especially at this point of time, I wouldn't call it a crash. In fact, we're just pulling back to where we traded on Wednesday. Didn't even take out Wednesday's lows, actually. So like I said, the China trade's going to be volatile and could very well keep dipping down, but like I keep saying, Chinese government is determined to get underneath their markets this time, and so the weaker their markets get, the bigger the stimulus they'll throw at it. And so I think that's kind of like just fighting the tide. It's almost impossible to do in the long run. But like I said, it's a complex matter. It's going to take a bit of time for this tariffs to play out along with their economy getting back to above 5% GDP growth, and also be watching the Chinese yuan, which has come off quite a bit since the US presidential election as well. But like I said, some other countries may be the beneficiary from big American companies looking to source their products from other countries. If China does get indeed slapped with a 60% tariff, there's South Korea currently at a support zone. And other low-cost labor countries, Brazil with a big commodity tilt is another interesting one. And what could actually be a leveraged play on the US economy, Mexican shares appeared to catch a really big bid and buy the dip after they initially had a huge gap down off the election, which tells you the market initially thought they were going to suffer, but some big money came in there and said, we'll take those shares, thanks very much. At least that's what it looks like to me. And there's a look at other popular Chinese ETF, KWEB, internet shares. It too had a bit of a support box here. But those tariffs won't just hurt Chinese companies. Just looking at some equity industry returns from 2018 to 2019 and their excess returns versus S&P 1500 during 8 tariff risk episodes, semiconductors actually underperformed the market during that. Obviously, China ADRs, also known as golden dragons, tech, capital goods, autos, materials, stuff that's all exposed to China. It's actually the defensives that did well, utilities, telecom, REITs, and staples. So that can cause a bit of volatility in the American market as well. It's going to take the market and economy a little bit of time to swallow because it is a pretty big deal, global tariffs, which has ripple effects across all financial markets, even crude oil futures today, trading down, another underwhelming response to China's latest stimulus, and no doubt the new admin is going to drill, baby, drill, keep pumping out the black stuff at record. And with fracking and AI, so the industry is just going to get even more efficient at doing so. And just an interesting infographic I thought I'd share with you guys today. Top countries by natural resource value. Out in front, Russia, coal, natural gas, oil, timber, rare earth metals, 75 trillion. They do have the largest land mass in the world. Coming in next, the United States, a really rich, diverse land as well, 45 trillion. The Saudis, full of oil. Same with Canada. Canada should be up there with the Saudis in pumping oil and how efficiently they do it. So there's a lot of unlocked potential in Canada as well. And of course, Iran has a lot. China's big on rare earth metals, which Americans rely on a lot. Brazil, a resource-rich country, just as Australia and other parts in the Middle East and South America as well. Venezuela is up there with the most amount of oil in the world. They've just unfortunately been overrun with socialist governments to the detriment of all their citizens, except of course the very few at the top. Now let's move it over to Bitcoin. We heard from Tom Lee today. He actually thinks it could hit 150,000 by the end of the year. That's a huge forecast. But he also suggested Bitcoin as a potential treasury reserve asset that could play a unique role in managing national debt. He stated that traditional measures like adjusting taxes and spending may not be enough to address the growing US deficit. As Bitcoin's price increases, it could help offset US liabilities, easing some pressure on the deficit. And this is something I've been thinking of late as well. It could play a role in getting Americans' debt down and certainly puts the US in a unique position against China, which has largely been anti-crypto, kind of phased it out of their system over the last couple of years. We were thinking there may be the threat of central bank digital coins, which could still come, especially with a change of government. But this government, at least for the next 4 years, looks to be pro-private crypto, Bitcoin. And what's funny is we've got Bitcoin sitting at brand new all-time highs, 76,500, absolute rip since election day. It's had multiple tailwinds over the last couple of months. There's no overhead resistance now, nothing to stop it from indeed running to 100,000 by Christmas. But the funny thing is, even though we're sitting at all-time highs, and that normally attracts a lot of attention, participation, speculation, all that good stuff, we're just not seeing it. And in this data here, of YouTube views of all the most popular crypto channels, currently around 1 million a day, just well off those peaks from 2021, getting up to 4 million new views a day. That pretty much lasted all throughout the year. We can also see that in Google search volumes as well, for the search term Bitcoin. Using its peak as a reference of 100 on this index, we're currently at 37, more than 60% down, people searching for Bitcoin on Google. Same with the search term buy Bitcoin, which you can see had a peak in January 2021. Using that point as a reference of 100, we're currently at 19. Similar story for the search term buy stocks, still well off those peaks from 2021. So just like I've been noting of late with margin debt and other data we're looking at here on YouTube, Google, public participation in both the stock and Bitcoin bull markets nowhere near the peaks, suggesting there could potentially be a lot further to run, because typically markets peak out when everybody and their dog is talking about it and jumping over each other to get in. Classic late stage bubble. A lot of what I'm seeing is more closer to early cycle, potentially mid-cycle, which again I know is quite a contrarian view. However, that's just what the data and charts are suggesting to me. And just moving on to a potential threat to meta platforms. Australia going to ban social media for children under the age of 16, which I've got to say I agree with. Don't think we should have 12-year-old kids on social media and all the negative mental health effects that have been proven to come with that. Bit of a mental health crisis with young people, and that correlates very closely with the rise in social media, which you can see in the skyrocketing rates of US 12 to 17-year-olds with major depression in the last year. Really took off in 2010, 2011, especially in teenage girls. Unfortunately, we've seen the same pattern in US teen suicide rates ever since 2010, just skyrocketed. And there's actual correlation between social media sessions per week and depression symptoms. The more teenagers use social media, the more depressed they are. And here's the number of people using social media. Again, you can see in 2010, 2011, it really took off. So there's no doubt that social media usage is linked to mental health issues, for which Mark Zuckerberg has been heavily criticized. Since even though he verbally acknowledges it as being an issue, his actions suggest otherwise. A lot of teenagers still flooded with push notifications on their phone every day, inviting them to come back to his apps, nor have enough measures been implemented to prevent harm to them. And so his position has been the app stores need to regulate this age requirement in Australia, not him, and Australia may set a precedent around the world. As I agree, in my opinion, no teenagers should be on social media, as you could kind of think of Instagram as just being a highlight reel, a show off, and that makes teenagers feel bad because they don't feel like they're good enough. However, so far Zuckerberg has avoided personal liability. In Meta, addiction suits, and I think if left uncontrolled, he'll just do the same thing with virtual reality and metaverse as well, which actually could turn out to be a whole lot worse for teenagers than these current social media apps. As always, the market doesn't really care about all that. They only care about forward EPS earnings expectations. There was no real reaction in the stock market today. And plus, at the end of the day, teenagers aren't the biggest consumers anyway. It's not a huge loss of advertising revenue. The meat in the market is more in young, middle-aged adults. But nonetheless, reducing their active users, certainly not a positive thing for their business. And that's why no doubt the Zuck is going to continue making it difficult for them to do that. Looking out to next week, the US will be observing Veterans Day this coming Monday, honoring those that have served in the military. The stock market will be open, but the bond markets will be closed, along with most banks, and the US Postal Service will not deliver mail on Veterans Day, but UPS and FedEx still will. And we're now making our way to the back end of Q3 earnings season. We just came off the peak this monster week. Now next week we'll be looking at Home Depot, Cisco, Disney, and a few Chinese stocks next week as well. That'll be interesting to see. And just looking at the results we got in today, pretty good again. Mostly beats across the board. Getting back into the charts, we've still got the VIX crushing down here, currently down to 14.9. I think with no surprises, we'll be back on our way down to this support zone here around 12 come the end of this month. When the VIX crushes, it can crush hard. And just looking at volatility risk premium, 1.4 points. Option dealers not expecting much volatility around the corner. The 2-year yield holding up today, 425. Bit of a pullback in the 10-year, 430. High yield bonds climbing back up. Dollar just kind of hanging around above 105. And gold had a bit of a pullback this week. And there's that pullback in crude oil today, which I would expect a lot more of this consolidation type pattern. But the story this week was really that growth rotation, which we can see all over the place. Discretionary stocks absolutely trouncing staples this week. But once again, the standout for me today was none other than Tesla. Massive volumes coming into the stock here. 203 million shares at $321 a share. This is getting short squeezed. Hedge funds, still the most shorted stock out there. And unfortunately, the mainstream media has convinced a lot of people to hate Elon and doubt him now that he's gone after the establishment. And unfortunately, that has blinded many people to the opportunity. But like I keep saying, I think their best days are ahead of them. And I'm certainly excited to see all their new products on the horizon as well. That's all for this historic week in financial markets. I've had a great week. I hope you have too. And now we all get to have an enjoyable and relaxing weekend. Thanks very much, guys. And I'll see you again next week. Cheers.